So the next topic that we wanted to cover was assumable mortgages. So the definition of that is a type of home financing in which buyers are given the opportunity to purchase a home by assuming responsibility for and taking over the seller's current mortgage. So there's some good and bad on that, of course.
And ugly.
Yes, and ugly. So the good.
The good about having an assumable mortgage is you have something unique that you can offer to the marketplace, to the buying marketplace, that nobody else can offer, other than other people with assumable loans.
Right.
And because of the situation we're in with mortgage rates, where a lot of people, the mortgage rates are just high. I mean, they're too damn high, in fairness, So,
your face.
So they're up to 6.5%, 7% now, and if you have an assumable.
Now, historically, that's not that high, but based on last year.
Well, based on the last 10 years,
yes,
it is high because it's been a lot lower than that for 10 years. And even the problem is not even 10 years, it's not even historically. A year and a half ago, it was half. So that's a major problem. That's a shock.
Right. It's a shock to the system.
Yeah. And anyway, hey, listen, it doesn't even matter. If you have an assumable loan with a low. Now, here's the thing. If your assumable loan has the same rate as market rate, it doesn't really bring that much value.
Right.
The only thing is it's maybe a little bit easier to qualify for, but not even that much because you still have to qualify.
And there are other factors that might not make it as easy, but yeah.
So the thing is, like 2 years ago, nobody ever talked about assumable mortgages because they didn't matter because basically the same thing as just getting a new mortgage.
Right.
Maybe it's a little more expensive getting a new mortgage, but it's not that much different.
Mostly when we're talking about assumable mortgages, the one that I know is VA mortgages.
Yeah, it's mostly. I think FHA used to be assumable. I don't know if they still are.
Think
Mostly it's VA.
Right.
Like nine times out of 10, if you talk about it, it's VA.
Right. So if you have a VA loan, this will mostly just apply
to VA
to you. Right.
Yeah.
So some of the things.
And if you have a VA loan, you might have to call us.
Right.
Because we know all kinds of stuff about this.
Right.
We do it all the time.
Yes. And so now to the not so good part, some of the potential challenges to assuming a mortgage. So one could be timeline, because when you're getting a new mortgage, you have a loan originator or a loan officer, and of course they're incentivized, they get paid when the mortgage is funded or it closes, right?
Yep.
So they're incentivized to make it quickly and efficiently and getting it done in a timely manner. When you have a contract, you have a timeline, 30 days, 40 days, whatever that is, and everybody's kind of pushing to make sure that they meet that commitment.
And the bank's incentivized to do it quickly too, because
they want to make sure it happens.
They like to push out new mortgages, sell and make money, blah blah blah.
Right.
Yeah.
On an assumable, you're now getting in touch with the servicer of the current owner's loan, and so now you're really calling the 1-800 number of the customer service, the servicing department. So that sometimes doesn't result in the most efficient, fast response.
Yeah. You know what it reminds me of? It's like if you've ever had a loan modified before, back in the heyday, 15 years ago, there was a lot of people that, had trouble with their mortgages. They get them modified. They'd have to submit the documents. It would take months.
You get in the queue. They'll get back to you when
Because like you said, there's no financial incentive. Nobody's making any money. You're just taking the same loan, just changing the name basically. Right.
So for the bank, there's really no priority.
The person doing it doesn't make any money. The bank doesn't make any extra money. So they don't really care. And so there's no incentive to go quickly.
Right. So timeline, it could be a challenge if you're trying to get something done quickly. You have to be flexible with your closing time if you're trying to assume a mortgage. That's one thing. And the other thing could also depend on the situation, but because you're assuming the current loan, you're taking over the current balance of that loan. And depending on the appreciation or whatever the gap is from the current value of what the house is worth today versus the balance that the owner has in the mortgage currently, you will have to bring that cash to the closing table, because you're technically only taking over whatever that current balance is, and most likely it's going to be smaller than what the current value is.
So it really kind of depends on how long this person's owned the house. If they've owned it for a long time, it's extremely likely there's going to be a huge gap between the mortgage balance and the price you're going to pay for the house.
Yeah.
So you got to take that into consideration. But doesn't mean it still can't work. There's still ways to make that work out. And
just some things to consider, Yep.
Yeah. All right. Well, that's pretty much it on Assumable. Assumable is a valuable tool. It's a little bit tricky. And again, if you would like to discuss If you have an assumable loan, particularly VA, and you want to dive into how that can benefit you in selling your home, call us because we'd love to talk to you about it.
Yeah.
Bye.
Bye.